All right, today we're going to tear down the official documents for the Invesco India Nifty Bank Index Fund. We're going straight to the source material, the pitch decks and the fine print to see what this fund is all about, how they sell it to investors, and what the legal documents really have to say.
So the entire case for this fund, the whole argument really, rests on this one powerful idea, taken directly from their own pitch. The idea is that India's banking sector isn't just a part of the economy. No, it's the very engine that's driving the whole thing forward.
It's a compelling metaphor, right? An engine. But before we get too deep into that big economic picture, we first need to understand the vehicle itself. So our first question is a simple one. What exactly is this fund?
Okay, so at its core, this is an index fund. Now, what that means is it isn't trying to outsmart the market by picking winning stocks. Its one and only job is to mirror the performance of the Nifty Bank Index, which is basically just a basket of India's biggest and most important banks. It's open-ended, which just means investors can get in or out on any given business day. Really, it's a passive bet on a very specific and, yeah, very important sector.
So that's the what. Now let's dive into the why. What's the core argument that the fund's own documents make for putting your money specifically into Indian banks?
You know, the entire investment thesis really boils down to this one single sentence from their presentation. The logic is pretty simple. As India's economy grows, its banks are set to benefit directly, maybe even more so than other sectors. I mean, it makes sense, right? Economic growth needs capital, and banks are the ones supplying it.
And here's the data they use to back up that claim. This chart compares growth rates across a few different periods. Now, I want you to look closely at that first block, from fiscal year 05 to 11. See how the bar for bank loan growth is significantly taller than the one for nominal GDP growth? This is really the core piece of evidence they present to argue that banks don't just grow with the economy, they often grow faster.
So what has that meant for investors? Well, the documents point to this number, 17%. That's the approximate compounded annual growth rate that the Nifty Bank Total Return Index has delivered since the year 2000. And that term, total return, is key. It means that number includes reinvested dividends. That's a really powerful figure, sustained over a very long time.
And this chart here, it really visualizes that outperformance. It shows that during economic upcycles, the Nifty Bank Index, that's the blue bars, has often delivered much higher returns than the broader Nifty 50 index. The story the fund is telling is crystal clear. When the economy is booming, banking stocks don't just participate, they lead the charge.
So we've seen the why behind the fund. Now let's pull back the curtain on the how. What are you actually buying when you invest in this thing?
The whole mechanism is what's called passive investing. So unlike an actively managed fund, where a manager is trying to pick winners and losers, this fund just follows a set of rules. Its only goal is to own the stocks in the Nifty Bank Index in the same proportions as the index itself. It's an automated approach that's designed to be straightforward and, as we'll see, lower in cost.
And what does that index actually look like on the inside? Well, this chart shows a really heavy concentration, over 71% in private sector banks. Public sector or state-owned banks make up about a quarter of the index. So you're getting exposure to both, but let's be clear, this fund is definitely dominated by the private players.
And to make that a little more concrete, here are the names at the top of the list. These are the absolute heavyweights of Indian finance: HDFC Bank, ICICI, State Bank of India. You know these names. These companies alone make up a huge portion of the index. So when you buy this fund, you are buying a piece of these specific giants.
So the documents summarize the benefits of this passive structure pretty well. You get transparency, lower costs, and no manager bias. But that last point, automatically following the index, well, that cuts both ways. It follows it for better and for worse. And that for worse is the perfect transition. Okay, we've seen the glossy marketing presentation. Now it's time to turn to the official key information memorandum, the legal document. To understand the risks involved, this is the reality check.
And the very first thing you see is this, the official riskometer. And it's not rated moderate or even high. The fund's own documents classify its risk level as very high. That stands in pretty stark contrast to those smooth, upward-trending performance charts we just looked at.
So why is the risk so high? Well, the main reason is what's called sector risk. Because this fund puts all of its eggs in one basket, the banking industry, its performance is completely tied to the fortunes of that single sector.
Any change in interest rates, regulations, or the economic cycle that hurts banks is going to directly hurt this fund. There is absolutely no diversification.
There's also a more technical risk called tracking error. In simple terms, this just means the fund might not perfectly match the index it's built to follow. And why not? Well, little things like fund expenses or having to hold some cash to pay out investors, these can cause its performance to drift a little bit from the index's return. The documents say this error shouldn't be more than 2%, but it's still a risk to be aware of.
And finally, we come to what is, without a doubt, the most important sentence in the entire legal document. After all the charts and growth projections, the crucial point is this direct quote: "There is no assurance that the investment objective of the scheme will be achieved." It's a mandatory legal warning, sure, but it's a vital reminder that past performance guarantees absolutely nothing.
So after deconstructing all the documents, we're left with this question. The pitch presents Indian banks as the key to the country's growth, but the fine print calls it a very high risk. So is this a strategic play, or is it just a high-stakes gamble? The source material lays out both arguments, and it leaves that final decision up to each investor's own appetite for risk.